Welcome back to another thrilling episode of Principles of Finance. Today we're going to talk about cost of capital. When we talk about capital, we mean money. What's the cost of raising money? Whether we borrow the money as bonds or whether we get investors as stockholders. These have a cost to us. And we're not interested in the cost in dollar terms, but we're going to look at percentages. And that'll be important as we look at new projects that we want to undertake. We want to know if the return on the project is going to be greater than the cost of capital. If the return on a project is greater than the cost of capital, we do the project. If our rate of return is less than the cost of capital, we're not going to do the project. Now, cost of capital is denoted by the letter K. Why? I don't know. Somebody didn't like C, I guess. And K sounds like C. So we'll use K as the cost of capital. And you can think of it as the minimum required rate of return to undertake a new investment. I hate to read slides, and I'm sorry about that, but that's what it is. In other words, if my cost of capital is 5%, then I'm going to need at least 5% on any project I do to undertake it before I start doing it. We'll come into the fact that it's a weighted return in a minute, but the fact that we are going to have to weight it in terms of some of the money we raise might come from stocks and some might come from bonds. So we'll talk about that. But you should know how to do weightings. We did weightings of a beta. Right? We did in terms of the beta of a portfolio, and we calculate the weight of a cost of capital the same way. But we'll come to that. Cost of capital. Well, I want a required rate of return on a project or for my money. Right? Whoever gives me the money is going to look for a required rate of return. And there's going to be a cost of financing. I don't get this money for free. To sell bonds, I have to pay an investment banker. To sell stock, I have to pay an investment banker. So there's some costs in raising the money. Now, the cost of capital is often referred to as the hurdle rate. Gets its name from track and field, right? You run the hurdles and you got to jump over the hurdles. Well, same thing. When you talk about financing, I have to get over the hurdle rate in order to undertake a project, right? I have to have more than the hurdle rate. It's another hoop that you have to jump over in business. Now, the cost of capital, it's kind of like the rate of return, but we got other factors in here, especially for bonds. For bonds, when you pay bond interest, it's tax deductible. So our costs are not going to be the same as potentially for dividends, stocks which pay dividends, because we can deduct the tax rate. I'll show you the calculations in a minute. And as I said earlier, we have to account for the transaction costs. We want what we call the net proceeds after transaction costs. So you're going to hear the term transaction costs, and then you have to calculate what the net proceeds are. All right. For debt, we'll talk about, the book talks about debt. We'll talk about debt in cost of capital when we mean bonds. We're selling bonds. Now, in practice, what we want to do is solve the rate. So when we get into Excel, we're going to use the rate function. And the present value is going to be the amount that we get from the bond. I'll go over this a little more slowly in examples in a minute. But it's the net proceeds. So if we sell $1,000 in bonds and the investment bankers take $20 on each bond, we may only get $980, and that's going to be our present value. We're going to calculate the rate, and the rate that we come up with, then we have to adjust for the taxes. So we do all this whole rate calculation, and then when we're done, we're going to multiply it by 1 minus the tax rate. Preferred stocks, we don't have a stock price. It's going to just be our cost of capital is the dividend required on the bond on the common stock, the dividend required on the common stock, divided by the net proceeds. Again, it's one of those perpetuity things, right? Let's take a look at a cost of debt example. And we have two views. We got the view of the investor, we have the view of the firm. Let's suppose we have a par value bond of $1,000 and it pays interest of $50. We'll assume in this case it's annual amounts. We're not going to do the semi-annual, but it pays $50 a year. The investor may be paid $987 for it, whatever the market price was. Well, if it's a 10-year bond, you can calculate it and get a 5.17% yield to maturity. Okay. Tax rate for the investor doesn't matter. Tax rate doesn't count because the taxes on a bond are income tax. You have to pay tax on the interest. So the required rate of return for an investor on a bond is 5.17%. Okay. But now the company that issues the bond is a different kind of view. Their cost is different. They still pay $50 in interest a year, but the price that they get, when we talk about present value, the price is really the net proceeds. And if we had a par value of $1,000 and the investment bankers take $45 out, our net proceeds is only $955. We're going to use that as the present value when we do our calculations. And in one of the other videos, I'll actually do the calculations of these using Excel. Number of periods is the same. The par value is the same. Notice the par value is the future value. The firm has to pay that $1,000 out there in the future. And we're going to use Excel to calculate the rate. Notice if I use the 955 in terms of the net proceeds, my rate becomes 5.6%. It's different than the investor's view. Why? Because the investor has a higher price. Now, the firm also has a tax rate of, let's say, 35%. If the tax rate is 35%, then we adjust the rate that we calculated, the 5.6%, and multiply it by 1 minus the tax rate to get our cost of capital equal to 3.64%. That's our hurdle rate. So as I said, we will undertake projects that will give us a return greater than 3.64%. This might be a little clearer after you look at the Excel examples. Next, we're going to turn to the cost of capital for common stock.